this is such a compelling product that, you are going to drain all the deposits out of all the banks and, the whole system's going to go kaput.
The narrow bank, rest its soul, was not a payments-related firm. It was totally for investment, safe investments. So for investors that wanted to put funds in a very safe place and earn a market interest rate.
It seems that, the Fed there, through bureaucratic maneuvering, managed to strangle this thing to death.
There was another submission that I noted by D.E. Shaw, which had tried to do the same thing and of course also failed, or we would have heard about it. Is there going to be some point in time where the regulators are going to say, no, wait, stop getting safer. We don't want you to be that safe.
You're too safe. Stop.
Stop. We want you to
be
take
riskier.
Banks deserve to have competition. Where there's a better product, it should have an opportunity to compete. If stablecoins do take off as a major part of our financial system, then banks would be threatened because they would either have to pay a much higher interest rate to keep their deposits, or they might even lose some of their business. I'm far from convinced, although you might not want to hear this, that stablecoins will take a significant fraction of commerce payments. They might have greater success in emerging markets for cross-border payments.
Well, Darrell, so to start, I noticed that you were a director of the Narrow Bank way back in the day.
Wow, you did your research.
Yes, we do our work here. And I think it's an interesting analog to maybe some of the current conversations about interest for stablecoins and so on and so forth. And I wonder if you could tell us a bit about that journey of being a director of the Narrow Bank, what it was like to try to build this product. And if I understand it, the talking point against it is that this is such a compelling product that, you are going to drain all the deposits out of all the banks and, the whole system's going to go kaput. So it rhymes with kind of the stablecoin conversation a little bit. And so I thought that would be a cool place to start.
Oh, that's an interesting perspective. And I hadn't thought about the connection that closely because the Narrow Bank, rest its soul, was not a payments-related firm. It was totally for investment, safe investments. So for investors that wanted to put funds in a very safe place and earn a market interest rate or close to it. And so it is connected to the yield issue for stablecoins. The firm was founded by Jamie McAndrews, a former New York Fed executive, with the idea that, large institutional depositors would like to be able to keep their funds in a very safe place and earn market interest rates. He got a provisional banking license from the state of Connecticut, and then applied for what would have seemingly been a routine master account at the New York Fed. But like many other firms that have subsequently tried, the Fed refused, or to put it more carefully, they initially didn't answer the request. They waited quite a number of years. TNB, its business was threatened by the long delay. It eventually litigated with the Fed, a rather heroic venture. It lost in the litigation because the court said that the Fed was still making up its mind, and this was 4 years after the application. So TNB never came to be, unfortunately, but other firms are apparently in line to get what Fed Governor Chris Waller calls a payments account, or colloquially a skinny account, which won't pay interest, but will give them the ability to make payments. And since that's their business, maybe that will be at least a partial success for those non-bank payment-related firms.
I wonder what you think of these counter arguments. It seems that, the Fed there, through bureaucratic maneuvering, managed to strangle this thing to death. And, I'm curious, as an expert on, market plumbing and financial plumbing, what do you think about, the sort of counter argument to the Narrow Bank sort of effort, which is that, it would drain all the deposits from everywhere else. It's going to be Armageddon. Like, what do you think of those arguments? Are they overplayed? Is this the bank lobby gone amok? Are there genuine concerns? I'm curious for kind of your take on that, Darrell.
Well, if stablecoins do take off as a major part of our financial system, then banks would be threatened because they would either have to pay a much higher interest rate to keep their deposits, or they might even lose some of their business to the extent that they are in fact harmed by the success of stablecoins. That would be bad for banking. Whether it's bad for the economy is highly controversial. banks deserve to have competition. Where there's a better product, it should have an opportunity to compete, in my view. And economists have written a number of papers on whether, in fact, there would be harm to bank lending, which is what the Fed was most concerned about. And I don't think there's any final consensus on that, but my read of the economics literature is that it would not be very damaging to lending, while it would affect bank profitability.
Could you talk a bit more about why that's the case? Is that because, look, like the banks would just have to pay more for deposits, and so the lending will go on unabated? It's just, look, your profit margin is compressed. Is it that, in fact, most of the lending is not done through the banks anymore, at least not in the sort of small business type picture that seems to be what people try to conjure up as the visualization of what's happening? I'm curious for kind of like the sort of the sort of gory details of this.
You seem to be a real student of the topic because you nailed both of the key hypotheses, and I think it's a combination of the two. First, banks, at least the largest banks, would continue to lend but would be less profitable because their cost of funds would go up. But they're getting below market funding and they're lending at above market rates. They have to cover their overhead to the extent that they can survive. They're just going to make less money, but continue to lend because the lending opportunities are just as profitable relative to market rates as they were before. The other hypothesis that you have in mind is that non-bank lenders will step in to the market, and that we already see evidence of that happening. Non-bank lenders, or private credit, for example, is getting to be a real phenomenon. There are questions about whether it's totally successful. Just recently, you've probably seen those, but it is the case that the market equilibrium would probably be more lending from non-banks if stablecoins start to take a significant fraction of the domestic economy. And by the way, Hanan, I'm far from convinced, although you might not want to hear this, that stablecoins will take a significant fraction of commerce, of payments in the retail, at least part of the U.S. economy. They might have much greater success in emerging markets for cross-border payments, or maybe for financial market settlement. But as far as making a car payment, buying dinner at a restaurant, and so on, I think it'll be a real challenge for stablecoins to gain a big toehold in the U.S. Domestic market.
I think we see that similarly. We've always been a bit baffled by kind of the sort of domestic stablecoin plays that expect a consumer shift into stablecoins. It never has made sense to us, and that's why we try to focus very much outside of the U.S. That makes a ton of sense, and I wonder what's sort of the macro picture here, right? So you have this kind of rise of private credit, which perhaps is taking the lending, maybe the worst part of the lending that the banks used to do pre-08, and now it's being done in this sort of arguably better way, right? There are less asset liability mismatches at bare minimum, but it seems the credit quality of many of these funds is not particularly high. They seem to be, primarily financing these LBOs that are over levered and just went from, let's say 6 times EBITDA to even more after these sort of businesses, primarily software businesses, have really suffered. So I'm curious, kind of like, what is your macro view on these? Are these changes in the economy healthy? Are they unhealthy? Should we be trying to push them another way? Just kind of curious for the big picture view from an expert.
Yeah, well, I'm a big believer in competition and innovation. So if non-bank lenders can make a go of it without blowing up the economy, I think that's good for the economy. And I think what we're seeing just now with very significant redemptions at some firms is some degree of concern by limited partners over things like traditional software companies getting beat up by AI, and rumors that maybe their returns won't be as good as they had hoped, and then then there's going to be a run sort of phenomena where if they're going to get out at net asset value, they want to get out before others get out.
Right.
But I'm not overly or concerned about this. I think it's a normal part of the business of being in a risky private equity environment that your investors might want out at some points in time.
So it seems that it is a significant regulatory achievement. The system is working the way it ought to be, with respect to that, at least.
Well, we're not sure because private credit firms are not as heavily regulated. The business development companies, or BDCs, they're regulated as traded firms, so they have some disclosure requirements and so on. And then there are the non-BDC firms, which are less carefully, observed by regulators. So everything is not necessarily fine, but as you mentioned a moment ago, their funding tends to be long-term.
Right.
So they're less subject to runs. Redemptions can be gated. So I don't expect the system to blow up. And by the way, while the phenomenon is really impressive in terms of its growth, it's still a tiny fraction of bank lending. Not to mention the corporate bond market, which is also very big.
Right. And so perhaps not as consequential as the media headlines might make it out to be.
Well, from the viewpoint of, I think it's quite consequential for the firms that are involved and the investors involved. But as far as, the global landscape of credit, it's more than a pimple, but much less than a grapefruit.
Going back to the narrowbank sort of experience that you had, Darrell, I wonder what that experience was like speaking with regulators and trying to get them to do this thing, especially with somebody with your background, right? You're like, look, I understand the plumbing of this really well. I don't think this is going to be an issue. I think this is a great idea to do. What do they say? Do they say look, let's, sure, but maybe not when I'm in office, right? I'm kind of curious how that conversation tends to go at that level.
Very interesting question. So I need to be cautious, of course, because even though it's long ago history and TNB no longer exists, regulatory interactions are, sensitive matters. But I'll give you, and as a director, I'm not an executive. I'm not responsible for the management of the firm.
Right.
I wasn't at the time, and I'm not at all now because the firm no longer exists. But as a director, you do get to provide advice and show up at meetings where the official sector is present. And I did have a couple of interactions. The two most memorable ones were first responding to the Fed's advanced notice for proposed rulemaking on narrow banks. They had a different complicated technical term for what narrow banks are, but the Fed had, in my view, a very imperfect view of the cost benefit of having narrow banks. And I advised TNB on what I thought would be some good debating points on their advanced notice of proposed rulemaking. That's a public comment letter. It should still be in the record. And I think you'll find TNB's submission to be useful reading. There was another submission that I noted by D.E. Shaw, which had tried to do the same thing.
Oh, interesting.
And of course also failed, or we would have heard about it. And they had additional rather telling points about the Fed's perspective on the economics of narrow banks. So altogether, I didn't think the Fed had a very good argument. And I think we could tell that was true because the Fed took a long time to come up with an argument that they thought held water, and I thought did not hold water. I'm a big fan of most things the Fed does, and talk to people at the Fed all the time. But in this particular area, I think they just basically were uncertain about how to proceed, and they knew that a huge precedent would be created. And we've now seen that the Fed has been extremely cautious about creating precedents of giving access to Federal Reserve accounts to non-traditional financial institutions. And that's why Governor Waller proposed these skinny payment accounts. The other interaction I had was a meeting with the attorneys representing TNB and attorneys representing the Fed, where we basically talked it all out. And I'm not going to be able to tell you what was said at that meeting, but it was very interesting.
I wonder for I guess the first case where you could talk about that. I wonder like what is the steelman of the Fed's position? Why is it hopelessly diluted in your view? I would love to kind of hear the kind of back and forth that must have happened and kind of hold these ideas to scrutiny to see what really is true.
So, well, I'll give you a synopsis, but I really do recommend reading the Fed's advance notice of proposed rulemaking on Regulation D, which is
Yeah.
the reg that covers this, and the responses by TNB, which was quite extensive and careful, and the eShaw. The basic idea, the Fed's concern, or at least a stated concern, was in two areas. One, that narrow banks didn't really serve a useful purpose. I didn't agree with that, of course. They serve a very useful purpose in terms of providing the kind of safety of a deposit account that was not available elsewhere in the economy, and
Right.
also providing a deposit account that offered a reasonable interest rate compared to what one can get at a normal bank. Although that situation is improving now, and we're seeing Nubank and other digital banks, neobanks coming into the fabric of the banking system that are going to offer reasonable interest rates. The other argument that the Fed had was that this would harm credit provision because it would take deposits away from traditional banks, and quote unquote, therefore, traditional banks would offer fewer loans. There was a tertiary argument, which is that in a crisis situation, depositors could flee from traditional banks to a safer bank like a narrow bank. It was always the case that depositors could flee. They could flee to a relatively safer bank. We can mention JPMorgan, for example, which is a
Right.
common place for depositors to go when there's a banking problem. Or they could go to a money market fund. And so adding a narrow bank wasn't going to change that situation. And TNB had put forward to the Fed its willingness to contractually limit the quantity of deposits that it would be able to take. And so even in a bank run, it would not be responsible for taking very much deposits out of the banking system.
It sounds like they should have let you guys do it.
Well, yeah, I mean, I still believe it. I still believe it was a terrific business plan. And of course, as a business plan, it was also a great idea as a business opportunity for the founders of the bank.
It's very elegant as well. One product, enormously compelling.
You could imagine. Let's take a bank today that decides it wants to get safer and safer, and heading towards holding only Federal Reserve deposits.
Right.
Is there going to be some point in time where the regulators are going to say, no, wait, stop getting safer. We don't want you to be that safe.
You're too safe. Stop.
Stop. We want you to
be
take
riskier.
Yeah. Well, I mean, there is an advantage in having banks that take risk, but having banks that want to be real safe should be okay too.
Right. That makes a lot of sense. You are recently an advocate of a new kind of Treasury note, which, if I have it right, is a perpetual overnight rate Treasury security. Could you tell us a bit about that? And I think some of these ideas may crisscross in interesting ways.
Yeah, that was a project with Don Wilson. We wrote a paper for Brookings. Brookings Institution is a think tank that you're probably aware of in Washington. And our idea, which I think is highly pertinent today, is that if on-chain finance is going to become a big thing, then we need a proper cash settlement asset. And a stablecoin is a natural choice. It's not the only choice. I'll come back to that. I think tokenized reserves issued by the Fed would be even better. But a stablecoin is a natural choice as the cash settlement medium on let's say, a financial securities trading platform, or for moving collateral, for doing repurchase agreements, for any large-scale financial transactions. But there are no stablecoins today. I'm not aware of how yours is built, but there are no stablecoins today that are sufficiently resilient to run a multi-trillion-dollar financial market, which is where this is eventually going to go. You might say, well, USDC, it's very well regulated. It's quite safe. Yeah, I mean, it's very safe. It's perfect for everyday commercial use. But a stablecoin whose value could go from $1 each to 0.999 sounds very safe, but 0.999 is not going to cut it in a multi-billion-dollar repo trade. Not even close. So it has to be worth $1 or more, and with no threat of being worth less than $1, not even depegging by a tiny fraction of $1, or even for a moment, because that'll just cause mayhem in a very, very critical infrastructure and financial market. And there are sound principles guiding international finance put out by the Committee for Payments and Market Infrastructure that basically say either central bank deposits or something tantamount to central bank deposits should be the requirement of the cash settlement medium in critical financial market infrastructure. So with all that as a preamble, Don and I said, well, there's no stable coins today that are suitably resilient. What would it take to build one? Well, first we need backing or reserve assets that are going to be worth $1 every day for sure. Not most of the days or not approximately, but for sure. Right. And other than Federal Reserve deposits, the next best thing would be a Treasury security that reprices to $1 every day. And so we designed one and put out not in every detail, but we put out basically the term sheet on how the auction settlement would work and redemptions would work and so on. That would make it feasible to have a Treasury security that would be worth $1 every day. And then stablecoin issuers could use it as the backing for stablecoins, and it could even perhaps be the cash settlement asset backing collateral transactions like repurchase agreements. We went to a number of key players in the official sector and shopped our ideas around. There was a lot of interest, but so far no one has said, yeah, let's go ahead and build it.
I have a naive question here. I understand that the goal of this is to create the perfect kind of collateral instrument to back a stablecoin. Understood there. It's kind of sort of the perfect risk-free rate is maybe the way I think about it as a heuristic. But wouldn't this thing itself why not just use this thing itself as the payment instrument, right? If this thing gives me a risk-free rate, I can presume I can send it around. Why not just use it as the payment instrument? I don't know. That's probably wrong for some very obvious reason, but I'm curious for your thoughts.
Yeah. The reason is that while it's worth $1 every day, it's every day at the auction. And so away from the auction, it would be accepted like a stablecoin today is accepted as though it's $1. But if it's for a, $1 trillion market and, it's maybe close of business, there's some hiccup in the demand and supply and they cross at 0.9999, and then the guy on the other side of the trade is going to say, well, you need to tee up this transaction we just did, because 0.999 times $10 billion, that's leaving me way short.
Less than 10 billion.
Yeah, it's less than 10 billion. I need to be teed up, and this is a hassle. And why can't you just give me a stable coin that's trades, that is $1? And that's why I think tokenized reserves is really the ultimate answer to this question, because reserve deposits in the Fed are the unit of account. They are not only worth $1, they are $1.
They are $1. I think this is a much more plausible version of the future than I've heard advanced by the folks that want to do bank deposit tokens. It's never been explained to me how exactly that would work. Let's say you have a liquid market for there's a secondary market for these tokens. The banks themselves are levered. I don't really understand how that works. If it would just increase the volatility of these tokens dramatically, right? These would be inferior instruments. The central bank version of this seems much more plausible, at least on an economic basis.
Yeah, I totally agree. And well, having said that, I think tokenized deposits or stablecoins are fine for everyday commercial transactions. And we do that today. We pay each other in our bank deposits. When I send you money, you're basically getting money into your commercial bank account, and you accept it as though it's worth $1 exactly, because it is convertible to $1 almost all the time. It's only when your bank is about to fail that comes into question, and it rarely happens in the U.S. economy. But when Silicon Valley Bank went under, its deposits were threatened, a stablecoin backed by commercial deposits, USDC depegged by quite a bit for a day or two. And so while, stablecoin like USDC is perfect for most applications, and nobody ever stopped using USDC because it did fine, you wouldn't build a multi-trillion-dollar treasury market on top of that.
That makes sense. It's, because look, they can put like uninsured bank deposits in there, right? It just doesn't make sense. It's a fundamental plumbing. Understood.
Yeah, for fundamental core plumbing, you wouldn't want to do that. You want to
Yeah.
use, as I said, tokenized reserves, which is the regulatory standard for financial market infrastructure, or something as close as possible to that. There are other options. I've been actually working on this just recently. What are the other options? One would be a special kind of money market mutual fund that only invests in overnight repurchase agreements backed by government securities. It's very, very hard for that kind of a money market fund to break the buck. And then you could issue a stablecoin that's backed by that kind of money fund. Hopefully you tokenize the money fund so you can move the collateral on-chain and off-chain very quickly. So that's one option. Another is a narrow bank, where we started today. And there is a narrow bank that's proposing to issue stablecoins that are 100% backed by central bank deposits. And the name of that firm is Finality. I'm sure you've heard of it. It's spelled F-N-A-L-I-T-Y. And they're trying to get central banks around the world to let them deposit funds in the central bank and issue these stablecoins.
What do you think of that effort? I guess like, what probability would you put on its success? It seems like it's primarily kind of one of the world's hardest go-to-market motions. It seems like you got to somehow convince these very risk-averse, correctly so, right? Correctly risk-averse folks to sort of dip their toe in the water of something that could break, right? I'm curious kind of how you think about that.
I think it may end up depending on how much interest that these stablecoins can get out of the central bank deposits.
Yeah.
If they get none, they could still make a go of it based on fees, but it's going to be a lot harder. And the economics of that kind of core financial market stablecoin are a lot less attractive if you can't get interest. Right now, central banks around the world are having this conversation. I know because I talked to them. Not the U.S. The Fed hasn't spoken at all about tokenizing its reserves, but the ECB, the Bank of England, and the Bank of Japan, the Bank of Canada are all doing experiments and talking about tokenizing their reserves. And I expect at least one or two of them to start doing that in the next few years. The ECB has a project called Appia, which may lead eventually to a digital euro, not the one that we've been reading about, the CBDC, but rather a form of tokenized reserves that's only for banks, that's used for wholesale finance.
I wonder what you think. Darrell, let's say tomorrow you were like the dictator of the global financial system. I wonder, as an expert in the plumbing, like what would you change immediately? And, the goal is, of course, clearly just in the public interest, right? Like what would be in the public's interest, not perhaps existing institutions or other folks?
Well, I mean, I would start. I mean, in the arena that you and I have been discussing for the last minutes, I think one of the first things to do would be to begin to investigate tokenized reserves. What are the costs and benefits? How would you do it? What types of platforms could they circulate on? Would it be limited to only banks being able to hold them? That would be literally the same thing we have now. Although there are a few special purpose financial market infrastructure that also have deposit accounts at the Fed, like the Chicago Mercantile Exchange Clearinghouse and one or two others. So what would be the perimeter for these tokenized reserves? That needs to be investigated, and what would be the costs and benefits for Treasury markets, for example. And I would begin there. The other thing to consider is, do we have, in the world of stablecoins, which is a broader arena, now we're getting into retail finance, and retail payment systems. Is the Genius Act satisfactory in all respects, or should we already begin to consider improvements in the regulation of stablecoins? Even a year after the passage of the Genius Act, there is an agenda for improvements, and I would put a high on the list the trade-offs between privacy and compliance. Something I've been working on with others is this difficult balancing act that we have not only in the world of stablecoins, but in banking, of protecting the user's privacy while at the same time providing enough information to the authorities so that they can stop money laundering or financing of terrorism or sanctions avoidance. And that balancing act was never really addressed well in the Genius Act. It simply said the Bank Secrecy Act applies, which isn't, in my view, satisfactory, because even in the banking world, the Bank Secrecy Act is already leading to invasions of privacy with the volume of suspicious activity reports that are being filed. And in the world of stablecoins, as you know, it's very difficult to maintain privacy and at the same time be able to stop money laundering or counter the financing of terrorism. I know that, well, maybe you could educate me about the work that you're doing on stablecoins. I know that there's an element of privacy that you're trying to build into your stablecoin. I'm curious of how you're going to do that.
Yeah, so the core product today is a stablecoin foreign exchange sort of product, right? So if somebody hands us a unit of fiat, we can give them a unit of stablecoins, and over time we want to spread that to be most currencies in the world and most corridors in the world. So that's kind of the first level problem that we're focused on today. When it comes to the privacy concerns, I think they're certainly important, but I think perhaps they'll be the bottleneck 2-3 years from now. I think today still, for too many people, the swaps themselves are a little too expensive.
I see.
And so you'll hear commonly people talk about stablecoin sandwich, where, you know, they go from fiat into stables and then they move to some other place, other country to come out in fiat. This actually only works for a very limited amount of corridors because the prices are too expensive. And so our job is to compress those prices first. But the privacy aspect of it is, I think, clearly going to be important in the middle game.
I'd love to, if you have a white paper or a technical document that describes how your product or service works, I'd like to read about it. I've been following firms like Ubix and Erebor Bank and other market participants that are trying to provide a kind of fiat to stablecoin or stablecoin to stablecoin clearing service, but yours seems to be dedicated to the foreign exchange market, and I'm just curious about how it's built.
Yeah, absolutely. We'll send something over after the show. Yeah, 100%. I'm curious, Darrell, who you think are kind of underfollowed thinkers in this space, particularly, you know, sort of folks who really understand the plumbing of the system and where it might be improved. I'm curious kind of who you think are the people who are most criminally underfollowed.
Wow, there are so many experts in this area. Yeah, I want to be careful not to name names and then leave out names. Let me just be a little bit cautious there, because if I give you 2 or 3 names, I'm going to find out several other people that say, "Well, why didn't you mention me?" But I'd be happy to send you a list of 5 or 6 names afterwards.
Yeah, we'd appreciate that. I wonder too, on sort of a related note, you know, I saw that you had some thoughts on foreign exchange yourself on a recent presentation you gave at the Hoover Institute. You were talking, I think, at broad strokes about, well, look, you know, in a world where you have atomic settlement, you don't really need these kind of creaky CLS type institutions in the middle. I wonder if you could go deeper into your thinking there. I wonder how you see this playing out, and, you know, given your mastery of the plumbing, how you see these different pieces moving around over time.
Yeah. I wouldn't be surprised if CLS itself gets into the game of updating its infrastructure so as to allow atomic settlement using on-chain technology. It doesn't have to be a blockchain, but some kind of programmable ledger. The way that CLS Bank works now is, I'm sure you're familiar, at a very high level and taking out a lot of the details. Let's say a bank in Europe wants to exchange euros for dollars with a bank in the United States. The European bank would send the euros to CLS. CLS would hold those euros until it gets the dollars from the New York bank. And then once CLS has both the euros and the dollars in hand, it will release the euros to the US bank and release the dollars to the European bank. Again, I'm not doing justice to all the details because they can handle multiple currencies and there are lots of other features that are available, but basically it's a trusted third-party custody kind of approach. And what you could do, and I think this is pretty obvious for someone in your position, is to do an atomic swap by which the European bank simply assigns on a programmable ledger its euros to the New York bank when and if the New York bank has cryptographically assigned its dollars to the European bank. And with atomic settlement, neither bank is at risk that the other will fail to deliver. They would set an expiration time for the exchange because there is still the foreign exchange risk to be dealt with. The dollars might be worth less in 24 hours than they are. But other than that, this is a extremely safe and well understood technology. There's no reason that we should be waiting to deploy it. It's already been tested in a couple of instances. In one case, the Monetary Authority of Singapore and the New York Fed did a test called Project Cedar, in which they exchanged Sing dollars for US dollars. And in another example, Project Jura, the Swiss National Bank, and the French central bank, a national central bank in the Eurosystem, exchanged on a test basis Swiss francs for euros. And by the way, the name Project Jura makes perfect sense. I lived in Lausanne and cycled through the Jura mountain range, which sits on the border between Switzerland and France. So it makes sense that you call this Project Jura.
I wonder what you see as the catalyst to move beyond these kind of like proof of concepts between these central banks to like really sort of mainstream use of these systems. You know, much of the product market fit we're seeing today is starting in very small scale businesses, right? These are sort of folks at the fringes of the global financial system who are first adopting this. I'm curious kind of when you see the catalyst happening where all this inflects and, you know, the bulk of these volumes actually all move on to stablecoins, and kind of curious for your read on that.
Well, all is a big word. I think you'll see an S-curve of adoption where it'll go slow at first, then very rapidly, and then most of the market, or at least a large fraction, maybe not all, because there are many market participants that will be limited. But the catalyst is coming back to the same one we mentioned earlier. There's no suitable cash settlement asset that's tokenized at this point. We have conventional central bank deposits, but we don't really have a safe enough, resilient enough stablecoin in the major currencies to allow that. Once this really gets going, I would expect you would see this happening on many corridors. CLS Bank handles the major currencies and some minor currency corridors. But once this gets going, you could exchange Malaysian ringgit for Danish krona, and there would be no need necessarily, if you had an agreed FX rate, to go through a hub currency. And you could see stablecoin for stablecoin atomic settlement dominating a large fraction of the foreign exchange market.
How do you see that playing out? Because would you expect it to play out and kind of assert a similar market structure as in the fiat world today, where most things go through the dollar, right? Because of the liquidity dynamics. Would you expect that to happen, to replicate itself in stablecoin land as well? Or do you really expect these direct sort of more fringe currency swaps? Kind of curious for your analysis there.
So it goes to the issue of what's called price impact. So if you have a very large transaction and you don't have a ready price on the other side, then you would go through the US dollar. You would buy, take your foreign currency, buy dollars, and then sell dollars to buy foreign currency B. But if it's a smaller transaction where the price impact is not really an issue and there's an accepted market price, maybe there's an algorithmic market maker that's just setting a price on every corridor and then laying off the risk in using wholesale markets, then those smaller corridors could be done directly with algorithmic FX and atomic settlement in stablecoins. And we might see that in some number of years. I'm always hard-pressed to guess how long these innovations take, but I'm always of the view that if you have a better technology, it will win in the end.
And I guess in this brave new world, then what happens to the correspondent banks, that have today this privileged position of, perhaps facing CLS directly and then being sort of at the top of this hierarchy? I wonder kind of how all this plays out.
Well, they're already, perhaps from players like you, they're already under pressure to improve the quality and efficiency of their foreign exchange transactions, not only with respect to the cost, but also with respect to the delays and the reconciliation of these FX trades, which is often faulty. I don't know about you, but every time I get my, I visit a foreign university and I get my expenses paid, I would say roughly half the time, it's a satisfactory experience in terms of no mistakes, no big delays, and no big cut off the top. So I think it's natural that we're going to see a lot of pressure on traditional banks to improve and to adopt the technologies that firms like yours are introducing. And I've talked to a number of banks about this, and they're aware of their shortcomings, and they're trying to improve what they're doing.
Who among the banks do you think are the smartest folks who are like really up to date on what's happening, and who's maybe we won't mention the ones lagging behind, but I wonder who are the ones that are smartest in your view?
I would say the neobanks like Nubank, Revolut,
Yeah.
those types of firms are super nimble, super smart, very aggressive, and using advanced technologies, making the customer experience much better, and giving them better interest rates, better foreign exchange prices, and so on. But in terms of smartness, they're firms like JPMorgan, they're not stupid. They know what they need to do. They're building the tech. They're a bit slower, but they also they don't want to cannibalize their existing profitable businesses either. So the question is, what's the new market equilibrium? Will it be neobanks eventually eating a large fraction of the market, or will they be continually nipping at the heels of the giant behemoths?
What a great place to leave it. I think, this is a show to watch for the next 5 years. I think this is the most interesting show to watch. What happens in this kind of
I agree.
Next 5 years and 10 years. I think the global financial system will reshape in interesting ways. Thank you so much for your time, Darrell. We really appreciate it.
Hanan, it was a true pleasure to speak with you.